Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning a controlling interest over 51% of the subsidiary, but not 100%. Therefore, we do have a non-controlling interest. Our major component we will be dealing with is where the parent is selling a portion of the S common stock. So in other words, they have a controlling interest, but not 100%. They're going to sell some of the stock, still not going below the amount to have a controlling interest, not below 51%, but they have a difference in terms of the amount of the common stock that is held. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including our worksheet and then our consolidation worksheet where we have the parent and subsidiary trial balances we will be adding together and then entering our consolidation entry. We're mainly focusing in on one consolidation entry and just considering what would happen if there's a change basically to someone sells or P sells a portion of their interest in S. So we're going to have that sale take place. Well, let's look at our data. Data on the left-hand side. P purchases a percent of S on January 1st, 2000 X0 common stocks. They have an 80% interest. They purchased it at the book value, so we're not going to be having to deal with any kind of differential here. The fair value of the non-controlling interest in S was 20%, so 20% at that point. Then on January 1st, 2000 X2, P sold shares of S to a third party. So now P is going to sell some of the shares of S. They're going to sell 2,000 shares. So they're still going to have a controlling interest after that point. But now we've got the difference between the controlling, non-controlling interest is going to change after that sale happens. So the sales price is going to be the $70,000. The increase in the additional paid in capital is going to be the $14,000. Net income earned evenly through the year. Both companies declared and paid dividends on December 31st, 2000 X2. Equity method is the method that will be used. So let's just consider what would happen over here. Same kind of thing we'll think about in terms of, let's think about the net value of S first. So we're going to say, okay, assets minus liabilities are the 304, which are going to basically equal the equity section down here, which of course will be 304. Then let's consider that with a table in terms of P's amount or accounting using the equity method in S. All right, so let's first think about this second table actually, and this is going to be just reconstruction of the equity method. So we have the beginning book value, the beginning book value for the common stock, we're going to say is negative of this number. So that's the common stock, the starting point. And then we have the paid in capital, beginning book value is going to be the 20,000. Then the retained earnings, beginning amounts is that 160. Now note the retained earnings, that's the beginning balance at the end. The dividends and the net income would roll into it. That has not yet happened yet on the trial balance. Therefore, the number on the trial balance is the beginning balance. If we sum these up, then we're going to sum these up to the left. We've got the 280,000 being the beginning balance. In essence, just summing these items up to 280,000 before the current activity down here is then closed into the equity section. Now, before we move forward, I just want to point out, note that this purchase took place in January, so right at the beginning of the year. So we're not going to have to deal with like the middle of the year kind of transaction or transition from 1% to the other. We just want to consider the fact that, hey, before this point in time, we were considering and accounting for the equity method in P and doing our consolidation based on this 80%. And we're still going to have those beginning numbers we're dealing with, right? But now going forward, there's going to be less of a percent involved here, so that we're just going to lower that down. But it was for the entire year, so we're not going to have to like allocate between the years here. Okay, so then we're going to go to the net income. So the net income is going to be, we're going to allocate this out to the retained earnings. Net income is just going to be this 42,000. So I'm just going to say negative of that 42,000. Then we typically have the dividends. It would net into the retained earnings as well. Dividends are going to be this 18,000. So we're going to be picking up then that 18. So let's pick up that 18. Then that's going to give us the ending book value. Let's go ahead and sum these up. I'm going to sum them up vertically. I'll do them one at a time just to emphasize what we're doing here. We're just summing up. Oh, I didn't sum. Something went wrong. Something happened there, and now I got the caps lock on. Equals the sum of these, and then the sum of these, and then we're going to add these up horizontally and sum them up horizontally. Okay, so there we have that. Now let's consider what this change was with regards to the value, and we want to consider what's the new percentage that is included for the controlling and non-controlling interest. It was an 80% interest, and now 2,000 more shares were sold by P to someone other than S, some unrelated. So now they're part of the non-controlling interest portion now, when they were 2,000 shares included in the controlling interest. So let's think about, all right, the total shares outstanding. One way we can calculate that, we could say, all right, well, they've got 100,000 here. Par value is 10. So 100,000 divided by 10. So I could say that's how many shares we have outstanding. 100,000 divided by 10. And then we have the beginning shares owned by P. How much did P own at the beginning? Well, they must have they had an 80% interest. So that 10,000 times the 80% is what they started with. They sold then, we're saying they sold, let's say negative to subtract it, 2,000 shares. So that means what are they left with? The ending shares that they'll be left with will be the sum, or 8,000 minus 2,000, or the 6,000. There's still 10,000 outstanding. So now our new percentage, which will now be the 6,000, will now be the 6,000 over divided by the 10,000. So now we're at 60%. That would mean that the non-controlling interest percent, the non-controlling interest, let's put that here. Non-controlling interest would then be, we would think, 1 minus the 60 or the 40. Let's make that a percent. Go into the home tab, numbers group, percent. Let's go ahead and make that a little blue line down here. So there we have that. So now we're going to take that information and we're going to pull it into our table up top. So the second table recalculated the net income, or the net assets or equity section at this point in time, which are assets minus the liabilities, which is the 304,000, or the equity section. The equity section down here, 304,000. We're now going to reconstruct that with regards to the non-controlling interest, which is basically what this number is going to be at the end of the day. And then the controlling interest, which is going to be reflected using the equity method here. So let's think about this side. We're going to say the beginning book value. So the beginning book value. So note that this change took place, the sale took place at the beginning of the year. So we're going to put the full year's beginning book value, and we're basically reflecting these numbers now with our adjusted numbers, the 60-40, rather than the 80-20. So I'm going to say, all right, the beginning book value for the non-controlling interest are going to be these items times now the 40%. So I'm going to say negative sum of these items, and then close that up, times the 40% rather than the 20, and that's going to give us the 112,000. For the controlling interest, we're then going to take that amount. We're going to take and we could think about it this way. Maybe it would be easier to see it this way. Negative sum of the total first of the beginning balances will be 280. The non-controlling interest being that 280 times the 40%, and the controlling interest then being that 280,000 times the 60%. Okay, and then we're going to go to the net income. So the net income, let's go to the total column here. The net income is this 42,000, same kind of thing. I'm just going to say negative of the 42,000. So we'll pick up the 42,000 and we'll break that out once again using our new percentages down here. The 42,000 times the 60% for the controlling, 42,000 times the 40% for the non-controlling interest, and then we're going to be picking up the dividends. So I'll just call it dividends here. The dividends being the 18. So let's put that in the total column again. I'll say, let's make it a negative 18 breaking that out, same kind of percentages, new percents, this times the controlling percent of the 60%, and then this times non-controlling 40%. That gives us our end book, I'm going to say book value. So go ahead and sum these up. I'll do them one at a time. Equals the sum, and then equals the sum, and then equals the sum. So there we have them here, and obviously these two, if we add them up, we'll be adding up to the 304 in the total column. So that's it. We just basically just note we kind of reflected this whole thing with basically our new percentages down here, and now given that being the case, our adjusting entry will be pretty straightforward, same kind of process that we would have normally. So I'm going to be taking, this is the trial balance for P, trial balance for S. Let's add them up. Equals the sum of these two. I'm going to copy that and paste it on down. Normal process there. And then we're going to say, all right, normally we remove the investment account. I'll come back to that later. Then we get rid of the S side of the equity. So I'm going to say S side of the equity is going to be the common stock. It has a credit in it. To remove it, we will then debit it. So we're going to debit it. Then we have the additional paid in capital. So the additional paid in capital has a credit in it. We're going to do the opposite thing to it to remove it, a debit. Then we have the retained earnings. So we'll pick up the retained earnings. Oh, that's not it. Retained earnings. It has a credit in it. We're going to do the opposite thing to it, or a debit to remove it. Then we have the dividends. So we have the dividends down here. It has a debit in it. We'll do the opposite thing to the dividends to remove it. And then typically we go down to the income from S, which was recorded using the equity method. That's $25,000. So we could think about that being also recalculating we usually do the 42,000. We just want to make sure that we're picking up then the new controlling interest of 60% rather than the 80%. There's our 25.2, which can also be found in the table to the left. Then we typically put the other side, the 40% in this case, to the non-controlling interest, which we can calculate as the 42,000, just making sure we take our new non-controlling interest percent of the 40%. And then we typically have the non-controlling interest in the net assets. Now we have basically assets minus liabilities, 304,000, adding up to these items, 304,000. That's the same as the equity. So we're now just going to break this amount, the 304,000, between the controlling, non-controlling interest, just making sure we're picking up our new numbers, that being the 60-40, controlling, non-controlling. So let's go to the non-controlling first. I'm going to say negative, and let's say sum. And then I'll pull them over from here. So assets minus liabilities, closing that up, and then times non-controlling interest percent, 40%. Then let's go up top and do the other side here. I'm going to do the same thing, times the controlling percent, negative sum, assets minus the liabilities, closing that up, times the 60%. That giving us then, of course, that controlling interest. If we add up then assets and liabilities, they add up to 0, and we can go ahead and post this out. So again, straightforward because it happened at the beginning of the year, and we have that full year. So let's go ahead and just post this out. We're going to say, all right, here's the investment. Investment in S is up top. That should go down to 0. So I'm going to say that equals the 184.4. Then we're going to go on down to the common stock. Common stock has something in it. What am I doing? Common stock, 100,000. That's going to remove S's portion, bringing us back to P's portion. Just like with the additional paid in capital, same process, same result. Then the retained earnings, same kind of thing happening. So here's P, here's S. There's the total minus S brings us basically back to P. Then we've got the dividends. So we'll pick up the dividends of that 18. So that's going to take us to the 24. Then we've got the income from S. Income from S is going to be that 25,200. That brings us to 0, as would be expected. Non-controlling interest down below. Non-controlling interest in S. 16, and then the non-controlling interest in the net assets. That's going to be here. We're going to be pulling in the 121,600. So that's going to be it. The investment accounts down to 0. We have the equity accounts, basically ending balances reflecting P's numbers, in essence, removing S's numbers from the totals. We've got the investment in S going on down to 0.